Step 5. Mastering the art of saving and investing. Saving and investing are foundational pillars in building long-term wealth. While saving is the practice of putting money aside for future needs, investing goes a step further by actively growing your wealth. In this step, we will explore how saving and investing differ, how to set meaningful savings goals, an introduction to key investment vehicles, the importance of diversification, and the remarkable power of compound interest. By mastering saving and investing, you can put your money to work for you, creating opportunities for wealth accumulation that align with your long-term financial independence goals. Understanding the difference between saving and investing. Saving, the secure and stable path. Saving is a foundational component of financial planning, offering a secure and stable path to meeting future needs and financial goals. The primary purpose of saving is to accumulate funds for short-term expenses or emergencies, ensuring that you have money available when you need it most. Savings are typically stored in low-risk, easily accessible accounts, such as traditional savings accounts, money market accounts, or certificates of deposit, CDs, all of which provide a safe place to keep your money. These accounts are particularly useful for building an emergency fund, which is essential for protecting against unexpected financial setbacks like a car repair, medical expenses, or sudden job loss. The advantage of having savings is the ability to access the funds quickly when necessary, without the need to take on debt or use credit. This security is invaluable for peace of mind, knowing that you have a financial cushion to fall back on in times of need. For instance, an emergency fund of 3 to 6 months' worth of living expenses can help you cover essential costs during an unexpected life event, reducing the stress of having to borrow money or make compromises. However, while saving offers stability, it has some limitations, particularly in terms of returns. The interest rates offered by savings accounts are often very low, sometimes even below inflation. This means that while your money is safe and accessible, it may lose purchasing power over time due to inflation. In other words, even though you may earn interest on your savings, that interest may not be enough to keep up with the rising cost of goods and services. For example, if you deposit $1,000 in a savings account with an interest rate of 1%, you'll earn $10 after 1 year. But if the inflation rate is 2%, the real value of your money has effectively decreased, as $1,010 will not buy as much as it did the year before. Saving is an essential part of building financial security and providing a safety net for unexpected events. While it offers low risk and liquidity, it may not provide the best long-term growth potential due to low interest rates and the impact of inflation. For long-term wealth building, it's often necessary to explore additional investment options that offer higher returns, but the stability and accessibility of savings remain a critical first step in anyone's financial journey. Investing, growing your wealth for the long term. Investing is not just about growing wealth, it's also about putting your money to work for you, making it possible to achieve long-term financial goals such as retirement, buying a home, or funding your children's education. The central principle behind investing is to generate returns that outpace inflation and build wealth over time. Unlike saving, where your funds remain largely unchanged in low-risk accounts, investing involves placing your money in financial vehicles like stocks, bonds, mutual funds, ETFs, real estate, or even startups, with the expectation that they will grow in value. One of the most compelling reasons people choose to invest is the potential for compound returns. Compound interest works by generating returns on both your original investment, the principal, and the returns that have already been earned on that investment. This process allows the value of your investment to grow exponentially over time, creating a snowball effect of wealth accumulation. For example, if you invested $1,000 and earned a 7% return in the first year, you'd earn $70. If you left that return invested, the next year, you'd earn interest on the original $1,000 and the $70 return, further increasing your wealth. The longer you stay invested, the more significant the impact of compounding. However, it's important to understand that while investing can significantly outpace saving, it comes with risks. The stock market, for example, is volatile, and the value of investments can fluctuate based on market conditions, economic changes, and other factors. Still, despite the short-term ups and downs, history shows that, over long periods, investments in the stock market and other assets have generally produced higher returns than savings accounts. Investing also offers the opportunity to diversify your wealth. By spreading your money across different types of investments, you can reduce risk and protect your assets from significant losses in any one area. For instance, you might invest in both stocks, higher risk, higher reward, and bonds, lower risk, steady returns, as well as real estate or other assets. Diversification helps cushion your portfolio during downturns in specific markets, which makes it a safer strategy overall. For example, let's say you invested $1,000 in an index fund that tracks the performance of the overall stock market. With an average annual return of 7%, you could expect your investment to grow to $1,070 in 1 year. While the market may experience fluctuations and the value of your portfolio may dip at times, your money is working for you to generate returns that consistently exceed the rate of inflation. Over time, this growth accelerates, especially if you continue to reinvest any returns you earn. In essence, the more you invest, the greater the chances of achieving your long-term financial goals. The key is to stay disciplined, avoid panic during market downturns, and focus on long-term growth. Even if you can only invest small amounts at first, the principle of compounding will help your money grow steadily over time. Over the years, your patience and consistency in investing will build a stronger financial future for you and your loved ones. Setting short-term, mid-term, and long-term saving goals. Setting clear and realistic saving goals is crucial to financial success. Without a plan, it's difficult to determine how much you need to save, and for how long, to reach your financial targets. Different goals require different approaches. Some may be short-term, while others will be more long-term and require investment. Short-term saving goals, 0 to 3 years. Short-term saving goals focus on achieving objectives within a relatively short time frame, typically between 0 to 3 years. These goals are often linked to immediate or near-future needs, such as preparing for unforeseen expenses or planning specific purchases. Since the horizon is short, it's crucial to keep the savings accessible while minimizing the risk of losing money. As a result, it's recommended to use low-risk savings options like high-yield savings accounts, money market accounts, or certificates of deposit or CDs, which provide liquidity and relatively stable returns without significant fluctuations. Examples of short-term goals include building an emergency fund to cover unexpected expenses, like car repairs or medical bills, paying off smaller debts such as credit cards or personal loans, or saving for larger purchases such as a vacation, home renovations, or a new car. Each of these goals requires different strategies, but they share a common theme of being time-sensitive and needing readily available funds when the goal is reached. For instance, if you are aiming to save $15,000 for a car down payment in 2 years, you could break the total amount into manageable monthly contributions. By setting aside about $625 per month into a designated savings account, you will be able to accumulate the necessary funds by your target date. The advantage of this approach is that it provides a clear path to achieving your goal, and automating contributions ensures consistency and reduces the temptation to spend the money elsewhere. The key to success in short-term saving is discipline, regular monitoring, and ensuring that your savings remain liquid and easily accessible when the time comes to make the purchase or handle the expense. Mid-term saving goals, 3 to 5 years. Mid-term financial goals typically span a 3 to 5 year horizon and are often associated with significant life events or purchases. These goals could include things like purchasing a new car, funding a home renovation, or saving for a down payment on a house. Since these objectives require larger sums of money, they often require a more strategic approach than short-term goals. Instead of relying solely on low-interest savings accounts, mid-term goals may benefit from using investments that carry slightly higher risk but offer the potential for greater returns, such as bonds, balanced mutual funds, or other conservative investment vehicles. For example, if you are aiming to save $50,000 for a down payment on a house within 4 years, it's important to break this goal into manageable annual or monthly savings targets. In this case, you would need to save $10,000 per year or about $833 per month. To accelerate the growth of your savings, you can consider opening a high-yield savings account or a low-risk investment account. These types of accounts often offer higher interest rates than traditional savings accounts, allowing your money to grow more efficiently. When planning for midterm goals, it's important to also consider the level of risk you are comfortable with. Since you have a few years to reach your target, you can afford to take on a bit more risk in exchange for potentially higher returns. However, it's important not to go overboard with high-risk investments, as the goal is to balance growth with a degree of security. With consistent contributions and strategic investments, midterm goals become more achievable, and you'll find that by the time the target date arrives, you've accumulated the funds needed to meet your financial objective. Regularly reviewing your progress and adjusting your plan as needed will help ensure you stay on track. Long-term saving goals, 5+ years. Long-term goals often represent the most significant financial aspirations in a person's life, and they require careful planning and disciplined execution. These goals typically have a time horizon of 5 years or more and are focused on securing financial independence or achieving other major milestones. Examples of long-term goals include saving for retirement, purchasing a second home, funding a child's education, or building a substantial investment portfolio. Achieving these goals often involves using a combination of savings and strategic investments. Because of the extended time frame, individuals have the opportunity to take on more investment risk, which can lead to higher returns. This long-term outlook allows you to withstand market fluctuations and ride out economic downturns, which could be more challenging with shorter-term goals. Investments like stocks, bonds, real estate, and mutual funds become ideal tools to help grow your wealth, as they typically offer higher returns than traditional savings accounts or low-risk investments, although they come with greater risk. For example, if you are saving for retirement with a goal of reaching $500,000 in 30 years, starting early in investing in tax-advantaged accounts such as a 401k or IRA can maximize your savings. These accounts often come with benefits like tax deferrals or employer contributions, which can help accelerate the growth of your funds. While you may start with small contributions in the beginning, your ability to gradually increase your contributions over time, particularly as your income grows, will play a key role in reaching your target. Furthermore, as your wealth grows, it's important to reassess your strategy periodically. Adjusting your portfolio to align with your changing risk tolerance or financial goals can help ensure that you're always on track. Long-term goals require a commitment to saving and investing consistently, even in the face of market volatility. Patience and persistence are crucial. The earlier you start and the more disciplined you are, the more you'll benefit from compounding growth, which can significantly increase the value of your investments over time. Ultimately, the key to achieving long-term goals is staying the course, even when short-term challenges arise. With careful planning, regular contributions, and wise investment choices, you can make substantial progress towards securing your financial future. Introduction to investment vehicles, stocks, bonds, mutual funds, and ETFs. Stocks, high risk, high reward. Stocks are a popular investment option because they offer the potential for high returns, but with that potential comes higher risk. When you purchase stock, you essentially become a shareholder in the company, meaning you own a small portion of that company. This ownership entitles you to a share of the company's profits, typically in the form of dividends, which can provide a consistent stream of income. Additionally, the value of the stock itself can rise, increasing the worth of your investment as the company grows or performs well in the market. The price of a stock can be influenced by various factors, including the company's earnings reports, management decisions, industry trends, and broader economic conditions. The stock market is subject to market cycles, meaning it can experience periods of volatility where stock prices may rise or fall unpredictably in the short term. Factors such as geopolitical events, interest rates, and overall investor sentiment can cause stock prices to fluctuate significantly, Because of this volatility, stock investments are typically considered high risk, especially when compared to lower risk investments like bonds or savings accounts. However, over the long term, stocks have historically outperformed other asset classes. The average annual return for the U.S. stock market has been around 7 to 8% after inflation, which means that, over time, investing in stocks has the potential to significantly increase wealth. For instance, if you invest $1,000 in the stock market with an average return of 7%, your investment could grow to approximately $7,600 in 30 years, assuming you leave the money to compound and reinvest any dividends. It's important to note that the value of stocks can also go down, especially in the short term. Market corrections, economic downturns, and poor company performance can all lead to losses for investors. Because of this, it is crucial to understand your risk tolerance before investing in stocks. Long-term investors who can ride out periods of volatility may find that stocks offer substantial returns, but it's essential to diversify your portfolio and not rely solely on stocks for your investment strategy. For those looking to invest in stocks, it's often recommended to adopt a long-term approach, focusing on the company's fundamentals and avoiding reacting to short-term market fluctuations. Many investors choose to invest in diversified portfolios, such as exchange-traded funds, ETFs, or index funds, which spread the investment across a broad range of stocks and reduce the risk associated with individual stock picks. While stock investing comes with the potential for significant gains, it's important to weigh the risks and to invest according to your financial goals and time horizon. Bonds, lower risk, steady returns. Bonds are a type of debt investment where you lend money to a government, municipality, or corporation in exchange for periodic interest payments, known as the coupon, and the return of your principal investment when the bond matures. Bonds are generally considered to be a lower risk investment compared to stocks because they provide more stability and predictability. While the potential returns from bonds are typically lower than those from stocks, bonds offer a steady income stream, making them an appealing choice for conservative investors or those seeking to balance their investment portfolios. The basic premise of bonds is that you, as the bondholder, are essentially a creditor to the issuer. In return for lending your money, the issuer agrees to pay you regular interest payments at a fixed rate, called the coupon rate, for a specified period. After the bond matures, the issuer is obligated to repay the original amount of money you invested, called the principal or face value of the bond. There are several types of bonds, each with different levels of risk and characteristics. Government bonds are issued by national governments and are considered the safest form of bonds due to the low likelihood of default. U.S. Treasury bonds are an example of government bonds and are considered one of the safest investments in the world. These bonds often provide lower interest rates but are highly secure. Corporate bonds are issued by companies to raise capital. Corporate bonds tend to offer higher yields than government bonds but come with a higher level of risk, as companies can default on their debt if they experience financial difficulties. The creditworthiness of the issuing company is a key factor in determining the risk level of a corporate bond. Municipal bonds are issued by state and local governments. They are often used to fund public projects such as schools, infrastructure, and hospitals. These bonds can offer tax advantages, such as being exempt from federal income tax, and they tend to be lower risk than corporate bonds but higher risk than government bonds. The fixed interest rate paid by bonds makes them appealing to investors seeking predictable returns, particularly in a low interest rate environment. For example, if you invest in a 10-year U.S. Treasury bond with a 3% annual interest rate, you would receive 3% of the face value of the bond each year in interest payments. At the end of the 10-year period, you would receive your original investment amount, the principal, back. Bonds are often used as part of a diversified investment strategy because they can provide stability and income, especially in volatile markets. For investors looking to reduce risk in their portfolios, bonds can act as a buffer against stock market downturns, as bond prices typically move in the opposite direction of stock prices during market turmoil. Additionally, bonds can help offset the volatility of stocks while still generating income, making them an attractive option for income-focused investors or those approaching retirement. While bonds are less risky than stocks, they are not entirely risk-free. The risks associated with bonds include credit risk, which is the risk that the issuer may default, interest rate risk, which is the risk that bond prices may fall if interest rates rise, and inflation risk, which is the risk that the return on the bond may not keep up with inflation. Therefore, it's important for investors to consider the type of bond, its issuer, and the current economic environment before investing in bonds. Mutual funds and ETFs, or exchange-traded funds, diversified portfolios. Mutual funds and exchange-traded funds, or ETFs, are two popular types of investment vehicles that offer a way to invest in a diversified portfolio of assets without the need to select individual stocks or bonds. These funds pool money from many investors to purchase a variety of assets, which helps spread risk and provide exposure to multiple sectors or markets. The main advantage of investing in mutual funds, or ETFs, is that they allow investors to achieve diversification, which can reduce the overall risk of their portfolios. Mutual funds are typically actively managed, meaning that a professional fund manager oversees the fund's investments and makes decisions based on their research and expertise. The manager actively buys and sells assets within the fund to try to achieve the best returns for investors. This type of management often comes with higher fees because you're paying for the manager's time and expertise. Active mutual funds can offer opportunities for returns above the market average, but they also come with the risk that the manager may not perform well. On the other hand, ETFs are often passively managed and typically track a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. Instead of having a fund manager make decisions on individual investments, an ETF automatically invests in the same stocks or bonds that make up the index it tracks. This type of passive management generally results in lower fees compared to mutual funds. While ETFs do not aim to beat the market, they offer investors an efficient way to invest in a broad market segment or sector without having to pick individual stocks or bonds. For example, an ETF that tracks the S&P 500 will invest in the 500 largest publicly traded companies in the United States. This provides exposure to a wide range of industries and sectors, making it a relatively low-risk investment compared to buying individual stocks. By owning shares of an S&P 500 ETF, you are essentially investing in the entire U.S. stock market, which can offer a balance of growth potential and risk reduction. In contrast to individual stocks, which may rise or fall dramatically based on the performance of a single company, investing in a diversified ETF helps smooth out those fluctuations and reduce the overall volatility of your portfolio. The key benefit of both mutual funds and ETFs is diversification. By pooling money from many investors and buying a broad range of assets, these funds help spread risk across different sectors and industries, reducing the potential impact of any single asset performing poorly. This makes mutual funds and ETFs suitable for investors who prefer a hands-off approach to investing, as they do not need to research and select individual stocks or bonds. Additionally, both types of funds allow investors to access markets that might otherwise be difficult to invest in, such as international stocks or specific sectors like technology, healthcare, or energy. However, it's important to note that mutual funds and ETFs come with different levels of risk depending on the assets they invest in. For example, an ETF that tracks a broad index like the S&P 500 is considered a lower-risk investment compared to a mutual fund that specializes in high-growth, high-risk stocks. While mutual funds may offer the potential for higher returns, they also carry the risk that the fund manager may make poor investment decisions, which could result in lower returns. ETFs, though generally lower cost and more transparent, may not outperform the market and can still experience volatility depending on the market conditions of the index they track. In summary, mutual funds and ETFs are effective ways to diversify your investments without having to pick individual securities. Whether you choose an actively managed mutual fund or a passively managed ETF depends on your risk tolerance, investment goals, and preferences regarding fees and management styles. Both types of funds provide an opportunity to invest in a wide range of assets, offering potential for growth while helping to minimize risk through diversification. Diversifying your investment portfolio for stability. What is diversification? Diversification is a fundamental investment strategy that involves spreading your investments across a variety of asset classes, such as stocks, bonds, real estate, and commodities. The idea behind diversification is to reduce the overall risk of your investment portfolio. The concept is rooted in the principle that different types of investments react differently to market conditions. For example, when one asset class experiences a downturn, other asset classes may perform better or remain stable, which helps to offset losses and reduce the overall volatility of your portfolio. By diversifying, you aim to avoid putting all your financial resources into a single type of asset or investment. This can help protect your portfolio from large losses if one asset class underperforms. For instance, stocks are generally more volatile and can be significantly affected by market downturns, economic conditions, or company-specific events. Bonds, on the other hand, tend to be more stable and may perform better when the economy is sluggish or during periods of market uncertainty. Real estate, another common asset class, can provide income through rental yields and may also appreciate over time, offering a hedge against inflation. When you diversify, you also take advantage of the fact that different asset classes often respond differently to the same economic conditions. In times of inflation, for example, stocks may struggle, while commodities like gold or real estate may see price increases. Conversely, in times of economic expansion, stocks might thrive, but bonds could underperform as interest rates rise. By holding a mix of assets, you increase the chances that at least some of your investments will perform well, regardless of what happens in the broader economy. For example, imagine you invest in 3 different types of assets: stocks, bonds, and real estate. If the stock market takes a hit due to a recession or economic slowdown, your stocks may lose value. However, bonds may perform well during this time, providing a steady stream of interest income, and real estate may hold its value or even appreciate, particularly if you're invested in properties in high-demand areas. The performance of these different asset classes can help balance out the negative effects of a downturn in one market, reducing the overall risk of your portfolio. A key benefit of diversification is that it can reduce the likelihood of your entire portfolio experiencing significant losses at the same time. However, it's important to note that diversification doesn't guarantee profits or protect against all losses. It simply helps reduce risk by mitigating the impact of any one asset class's poor performance. The more diversified your portfolio, the less exposure you have to the risks associated with any individual asset or market. It's also important to understand that diversification can take different forms. You can diversify within a single asset class by holding different types of stocks or bonds, e.g., large-cap stocks, small-cap stocks, government bonds, corporate bonds, or across different geographic regions, e.g., U.S. stocks, international stocks. Additionally, you can diversify by including alternative investments such as real estate, commodities like gold, or even cryptocurrencies, depending on your risk tolerance and investment goals. However, over-diversifying, holding too many assets in an attempt to minimize risk, can have diminishing returns. If the assets in your portfolio are too similar or correlated with one another, diversification may not provide the protection you're seeking. Therefore, it's important to strike a balance between diversification and ensuring that the assets you hold complement each other, rather than just diversifying for the sake of it. How to diversify? Diversification is a fundamental concept in investing that involves spreading your investments across a variety of asset classes, industries, and geographic regions. This strategy aims to reduce the overall risk of your portfolio by ensuring that no single investment has a disproportionate impact on your financial health. By diversifying, you minimize the likelihood that a downturn in one area, whether it's the stock market, real estate, or a specific industry, will drastically harm your entire portfolio. For example, you might allocate a portion of your funds to domestic stocks, another portion to international stocks, and still another to bonds or real estate. Domestic stocks may offer opportunities for growth, but if the U.S. market is experiencing a downturn, international stocks may perform better. Real estate investments, on the other hand, can provide stability and income through rent, while bonds typically provide lower risk and consistent returns, especially in times of economic uncertainty. Furthermore, diversifying across different sectors of the economy, such as technology, healthcare, and consumer goods, can further protect your portfolio. Industries respond differently to economic cycles. What hurts one may benefit another. For instance, in an economic recession, consumer staples, e.g., food and household products, may hold up better than luxury goods. By ensuring your investments span a range of industries, you reduce the chances of a major financial loss. Geographical diversification also plays a crucial role. Investing in both domestic and international markets exposes you to different economies, reducing risk tied to the performance of a single country's economy. For instance, if the U.S. economy falters, investments in emerging markets or developed countries like Japan or Germany might remain strong. Ultimately, a diversified portfolio doesn't just reduce risk but can also increase potential returns. While some investments may underperform, others may outperform, and the overall performance of the portfolio becomes more stable over time. By strategically allocating your investments across various asset classes, industries, and regions, you're better positioned to weather market fluctuations and maximize the long-term growth of your wealth. The power of compound interest. What is compound interest? Compound interest is a powerful concept in investing and saving that allows your money to grow at an accelerated rate over time. Unlike simple interest, which only earns interest on the initial principal, compound interest earns interest on both the original investment, the principal, and the interest that has already been added to the account. This creates a snowball effect, where the interest compounds, or grows on itself, leading to exponential growth of your investment over time. The magic of compound interest lies in its ability to grow wealth faster as time passes. The longer your money is invested, the more interest you accumulate, which, in turn, generates more interest. For example, if you invest $1,000 at an interest rate of 5% annually, the first year you would earn $50 in interest, 5% of $1,000. In the second year, however, you would earn interest not just on the original $1,000 but also on the $50 from the first year, bringing your total interest to $52.50 for that year. Over time, this compounding effect can significantly increase the value of your investment. The frequency of compounding also plays a significant role in how much interest you can earn. Interest can compound annually, quarterly, monthly, or even daily. The more frequently it compounds, the faster your investment grows. For instance, compounding daily means that your interest is calculated and added to your balance every day, rather than just once a year, leading to slightly more interest over time. For long-term investments, compound interest can be especially powerful. When you start early, even small contributions to your investment can grow substantially. Over decades, your money has more time to compound and generate returns, resulting in significant wealth accumulation. For instance, if you invested $1,000 at an annual interest rate of 7%, compounded annually, for 30 years, your investment would grow to more than $7,600, without adding any additional funds. The key to taking full advantage of compound interest is starting early, being patient, and consistently reinvesting your returns. Over time, compound interest can make a small initial investment grow into a large sum, demonstrating the power of time and wealth accumulation. How compound interest works. Compound interest is often referred to as the eighth wonder of the world because of its ability to grow wealth exponentially over time. The principle behind it is simple: you earn interest not just on the money you originally invested, the principal, but also on the interest that accumulates. This process of earning interest on interest creates a snowball effect, where your wealth grows faster and faster as time goes on. The key to maximizing the power of compound interest is time. The longer you leave your money to grow, the more pronounced the effects of compound interest become. For example, if you invest $1,000 in an asset that earns a 7% return annually, you'll earn $70 in the first year. But in the second year, the interest is calculated on the $1,070 you now have, not just the initial $1,000. This results in a larger amount of interest earned in the second year, which will continue to grow each year. Let's break it down. After 1 year, you would have $1,070. In the second year, your investment grows to $1,144.90, thanks to the $74.90 earned from the interest on both your initial investment and the interest from the previous year. By the third year, the process continues, and the interest earned in that year will be based on the total amount of $1,144.90, growing the value even further. Over time, the interest earned becomes a significant portion of your total wealth. This exponential growth is especially powerful over long periods of time. A 10-year investment can have a noticeable increase in value, but if you let it grow for 20 or 30 years, the effects become truly impressive. The compounding process accelerates, allowing your money to work harder for you, creating substantial wealth over the years. To make the most of compound interest, it's important to start investing early, stay consistent with your contributions, and avoid withdrawing your money prematurely. The longer your money stays invested, the more time it has to compound, which can lead to significantly greater returns in the future. This principle is why it's often said that the best time to start investing is yesterday, and the second best time is today. The bottom line: mastering the art of saving and investing takes time and discipline, but it is an essential part of the journey toward financial freedom. By understanding the difference between saving and investing, setting clear goals, diversifying your investments, and harnessing the power of compound interest, you will build wealth that compounds over time. Consistent saving and smart investing will create a strong foundation for achieving financial independence and long-term financial success.